Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 378 of our YouTube channel and podcast, and I cannot be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in your long-term financial journey. Today, we are going to be talking about cash out refinances. And you may say, what in the world does that mean? Or maybe you say, I've heard of that before and I have some friends that did that. I want to know if it's good for me to do. What should I do? All these different types of things. So I'm going to give you the 411 on everything today. I'm going to give you what it is, how it works, how it may help, pros and cons, examples, all these types of things to get you better acquainted with the cash out refinance. And then I'll give you my opinion on whether or not I think it's something that can be useful for the average individual or not. So stick around for a discussion of all that and more in today's episode. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan. And that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions. And you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. Now look, personal finance has too many words, too long of a dictionary, too much of a glossary for you to know every single thing. And that's part of the reason why I do this show on a day-to-day basis, right? That's part of the reason why I'm here. I'm here to make some things that you may hear, some buzzwords, some ideas, some vocabulary words. I'm here to make them clearer. I'm here to, really just fish out what you need to know, what you don't need to know, and let you really know what things are, to actually teach you, right? To actually teach you what things mean. And today it's all about cash out refinances, right? Now we've heard about refinancing your home, right? Which is quite simple, right? To refinance means to do what? To finance again, right? To refinance. And so when you finance something, what are you doing? You're taking out a loan. So when you refinance, you're taking out a new loan and paying off the old one with the new loan that you took out. Okay. Typically you do that so you can get better terms on your loan, right? You wouldn't refinance to get worse terms. A lot of people do it to decrease the term of their loan, right? To decrease it from a 30 to a 15. But many people to do so and to get lower interest rates on the loan that they can get, right? But there's also the cash out refinance. And what it allows homeowners to do is to tap into the equity of their home, right? Equity being the difference between what your home value is worth and how much you still have left to pay on your home by trading in their current mortgage for a larger loan. Now, after paying off their current mortgage with the larger loan, homeowners can use the leftover money, right? The equity that gets cashed out on whatever their little hearts desire. Okay. Most homeowners use the borrowed equity towards home improvements, debt consolidation, or other financial goals that may be unrelated to the home. Now, home equity it's based on how much the home is actually worth, right? Not what you originally bought the home for, right? It's what it's worth minus what is owed on it. So basically, cash out refinancing means stealing from your original down payment amount, going backwards on mortgage payments and turning your home appreciation into debt, right? And so you can already kind of see where I'm going with this, right? Where I'm going with how I feel about doing this. But we're going to talk about it anyway, okay? Because maybe you don't just believe it by, hearing those things. So are many homeowners doing cash out refinancing? I think it's important to note if people are doing it. And I wouldn't talk about it if I didn't think it was relevant. So of course people are, right? Since home values have been blowing up in the market that we've seen, these have been taking off, right? More homeowners have been dancing to the beat of the cash out refi drum, right? In an attempt to take advantage of all of that equity that they're building up in their homes, right? When home prices are rising and rising very quickly, then these are going to happen a lot because the difference between what your home is worth and the amount that you owe on your home is going to keep getting larger and larger because what your home is worth is increasing more and more by the day. Now, in fact, between the first and second quarter of last year, the amount of cash out refis jumped 13%, right? Representing more than half of all refinance borrowers, right? So more than half of all refinance borrowers were doing cash out refinances. But just because other homeowners are jumping off a bridge with their equity does not mean that you have to, right? You don't have to do this, right? This is not something that everybody is going to have to come to at some point in their life, right? This is something you can 100% avoid, but I want to tell you exactly how it works and why you may want to avoid it. Okay, so how does a cash out refinance work, right? So it pretty much works the same as a regular refinance, but instead of shortening your mortgage term or lowering your interest rate, you get a bigger mortgage that also gives you access to cash, okay? So here are the typical steps of the cash out refinance, okay? First, you find out if you're qualified, okay? Every lender has different requirements for borrowers, but here are some common things that they check for. First, you need to have plenty of home equity. If you don't have any equity, there's nothing to cash out in the first place. So most lenders won't let you cash out all of your home equity. You'll probably have to leave at least 20% in your home. And you think about this, and it's quite clear why they do this. They do this for the same reason that they ask that you put 20% down in order to keep you from having to do PMI, private mortgage insurance, right? Basically, they just want to know that you're still in good faith going to pay off this loan and not leave them high and dry with no type of repayment of the loan that you took out in the first place. So in other words, you can do a cash out refi that's more than 80% of your home value in most cases, okay? Now, you gotta have plenty of home equity. You also need to have a relatively high credit score, right? So 620 or higher is typically what they're gonna look for. And of course, how do you get high credit scores? By dealing in debt, taking out loans, credit cards, all those different types of things, right? So the credit score thing, it's kind of this strong line around 620 because 620 is kind of the deciding line on whether you're going to get a mortgage or a mortgage at a conventional rate or not, right? And then they're also going to look for debt to income ratio lower than 45%. Right. So what this debt to income ratio is, and if you've taken out a mortgage, you know this, right? It shows how much of your income goes towards debt each month, right? And so if you're somebody who, abides by what I teach on this show, then your debt to income ratio is likely to be zero, right? Or very close to zero. If you're using a credit card each month, you may, from time to time, have just a tiny percent. But the higher your percentage, the more risk a lender takes in loaning you money, so they may choose not to. All right. So FYI, if more than 25% of your take-home pay is going towards your current mortgage each month, you really shouldn't do a cash out refi. Instead, you do a regular refi to lower your term and interest rate to decrease the amount that you're spending on your mortgage every month, right? That's more important than taking the cash out to do something with the cash, right? Ultimately, we want to be able to afford what we're doing in our financial lives, right? And selling a home becomes very, very difficult. But if you can refinance to a place where you have a reasonable payment, then that might be what you need to do. Now, of course, I would definitely say refinance in a place where maybe you can refinance to a lower payment, but you can keep making the payment that you are, or a higher payment, you just have a lower rate, and so you can pay off your mortgage faster. Maybe that's something that you should do as well. But of course, that's different than a cash out refi. Right? So if you do not qualify for a refi and your property isn't working out for you, it might be time to sell it, right? So if you're paying too much for what you have, then it might be time to sell it if you have substantial equity, not do a cash out refi, right? So the first thing you need to do is find out if you are qualified. Those are some of the parameters. Then you need to decide on your loan amount, right? So if you actually go through with a cash out refi, right, you need to figure out how much you want to borrow. So total up whatever it is you want to do, right? Maybe you want to do home renovations. Maybe you want to consolidate some of your debt, whatever, right? You're going to need to come up with some amount, right? So if you want to do home renovations, get an estimate, right? Get an estimate from whoever's going to do the renovations, figure out how much it's going to cost, all those types of things. For debt consolidation, you total up all your debt balances, figure out how much you'll need in order to pay off whatever it is, right? But don't forget, refinancing a mortgage comes with closing costs, right? So of course, if you're doing a cash out refi, it's going to cost you something. You need to make sure that this cost is actually worth it, right? So I'll talk more about costs as we move forward, but refinances are going to cost something. But let's just think about this for a second, just from a fundamental standpoint. You are trying to take out a loan on your home in order, let's say you're doing debt consolidation, right? You're taking out a loan in order to pay off a loan. So are you really making any progress? Maybe you have a lower rate on your mortgage, but are you really making the proper progress? I'd argue no. I'd argue that no, you aren't making the proper progress. You aren't getting any closer as far as net worth goes to getting what you need paid off. This is, gymnastics in order to get a lower rate, which I understand mathematically, but are you actually taking responsibility for what you're doing in your financial life? Or are you just going to go back into debt so you can cash out refi again later? Just my question to you, but you may want to think about that. Then once you decide on how much loan you need, right, then you will apply and you wait for the loan to process, right? So you submit an application to a lender, right? If the lender approves, you'll likely have to cough up a bunch of financial history paperwork like you did when you first took out the mortgage. Then you hang tight while your new loan goes through the gauntlet of checks and balances, right? And this will include a home appraisal because it's all based on the value of the home in the first place. And then ultimately, on closing day, you will sign a bunch of paperwork. Then your new lender will give you the money to pay off your old mortgage, right? If you didn't save for closing costs separately, some of your equity cash will be deducted to cover those, right? A few days after closing, you'll get your cash out portion and you can start on whatever plan you have with that money, right? That is how the process typically works. So here will be a good example for you guys. So let's say that your home is worth $300,000, okay? But you owe $200,000 on it, right? So you have how much equity? Right, $100,000, okay? So this $100,000 in equity can be useful to you, okay? So you decide to do a bathroom remodel that costs $40,000. But whoopsie, you don't have the cash and you haven't saved up the cash. But you want to do it now. Your wife wants to do it now. Your husband wants to do it now. Whatever, you're wanting to do it now, right? So what do? You do this cash out refinance, right? So you crack open this home equity piggy bank, and then again, most lenders are going to require that you keep at least 20% equity. So on a $300,000 home, 20% equity is $60,000. You have $100,000 in equity in the home, so you have $40,000 that you can take out. So your lender approves, instead of a $300,000 loan, a $240,000 loan. You use $200,000 of it to pay off your old mortgage, right? That's what you owed. You owed $200,000, right? But you forget to save up the $10,000 in closing costs, right? So that cuts into your cash out money, right? So your cash out, let's say, ends up being $30,000, which means you have to dial it back on that remodel a little bit, right? But you have $30,000 in order to do with what you will. Now, maybe you don't forget the closing costs, or maybe you have more equity that you can take out. Maybe it's not $40,000 for a remodel, whatever, right? But are we learning anything, right? Are we learning anything about delayed gratification? Are we actually moving forward in our financial life, especially on something like a remodel? Let's think about this. On a $40,000 bathroom remodel, are you going to be able to recoup $40,000 on the sale of your home? Not likely, right? And so if you're not even going to recoup the full cost of the remodel, right, and you're taking money out of your equity, right, so you're taking out debt, first off, to pay for the remodel, right, but you're also going back into debt, right, for something that you're not even going to be able to recoup later on. I mean, it just doesn't make a whole lot of sense, right? The debt consolidation thing, at least I can do the math, right? At least I can say, okay, the math makes sense. If you have a 6% debt on, let's say, student loans, and you're going to pay your student loans off with 2.5% mortgage debt, at least I can do that math and that makes sense, right? But is that actually going to get you to a place where you have long-term financial freedom? Which again is what I'm trying to do for you guys. I'm trying to get you to a place where you have financial options, okay? But if you're doing these cash out refinances, right, ultimately it's keeping you in debt, right? And if you remember anything from the financial action plan, you may remember the 7th part, which is concurrent with the 6th and 8th and 9th, right? The 7th part is pay off your mortgage early. And the reason that I tell you to do this is so you can have more cash flow, right? You have more cash flow to do more with. But if we stay in this cycle of having a mortgage, right, we're going to keep around our largest expense, maybe into and through retirement, which is going to increase the need for our retirement savings, right? And if we're spending this money on cash out refinances, and if we're spending this money on remodels and whatever else, then maybe this is not really worth it, right? And it'd be even worse if you were taking this money out and saying, let me go and, invest it. Again, I would understand the math but the utility doesn't make sense, right? What are we actually trying to do? Are we trying to get to a point where we don't owe anyone money and we have the ability to be free and make choices with our finances? Or are we just going back into debt to do something else and back into debt to do something else? And you know how I feel about doing that. That just doesn't work out for me, right? I don't think that's the most efficient way to long-term financial freedom. So I don't think this is the most efficient way to deal with your money. I heard some people recently talking about, why would you ever pay off your mortgage if you can get it at such a low rate and all these types of things. And I'm just like, I mean, part of me gets it. Again, I can do the math on the rates and things, but I don't understand why you would want to not own what you live in. I don't understand why you would want your largest expense to stick around. Again, just doesn't make sense to me. And what it requires, if you never pay off your mortgage and you keep cashing out and you keep refinancing, all these types of things, then what you're ultimately going to have to do is make the right decisions with your money on the other end for it to make financial sense. If you're just going out and buying whatever, or remodeling your home unnecessarily or whatever, right? Just doing what you want with the cash, going on vacations, whatever. Then, what are we really doing? If you're not reinvesting in some way to make a higher rate than the rate at which you're paying on your mortgage, then you're going to move backwards and you will have lost the whole game of refinancing in the first place, right? So why do homeowners do cash out refinances then, right? Why would this happen? Well, one would be to improve the home. And improving the home, the only reason it kind of makes sense to take the equity out of the home, to improve the home, is because it's, the value of the home and putting value back into the home. Part of me gets it. But again, if you're not going to recoup the value that you put back in, what are we doing, right? Consolidating debt, we talked about that. Getting a lower interest rate, right? Which again, we can do that through basic refinancing. We don't have to take the cash out. Then we haven't talked a whole lot about freeing up money to invest. I alluded to it a moment ago, but a lot of people do cash out refinances, especially when the value of their houses increase a lot, so they can just continue reinvesting the money and making the difference in the stock market. Now, over a long period of time, this is going to work, all right? Just admittedly, it is going to work, right? It's going to make higher rates of return in the stock market than a very low rate mortgage. I totally understand, okay? But we're going to continue to have our largest liability, right? A cost on our largest liability. And we're just going to keep paying and keep paying and keep paying. And it eats away at those investment returns over time, right? Instead of being able to net the entire return, now we're only netting a portion because we're paying the rest back to paying off the mortgage, right? And how would you feel if you did that and then you invested in, a bear market hits for some period of time, right? It might feel kind of sucky, but like I said, over the long period of time, that's going to work. But it is not the most efficient, nor is it the smartest way to reach long-term financial freedom, right? So again, I understand the numbers. And if you chose to do that, or if you chose to consolidate debt, again, I'm not going to chastise you for it, right? But again, I'm going to ask you, what are we doing here, right? Are we just simply trying to play mathematical games, or are we trying to get to this point where we don't have debt, we don't have strains on our cash flow, and we can just take our income and invest it and give it and spend it how we want to, right? Which is what I try to teach you guys all the time. Now, this last reason that I have here is interesting, okay? And I'll tell you, there's multiple reasons why it's interesting. But again, I don't think it's something that we should be doing, okay? The last reason would be to pay for a college education. So for like your children, right? Now, first off, having enough equity in your home to pay for a college education would require a good bit of equity. But let's say you got 3 kids, okay? Are you going to be able to take out the equity each time to pay for all their college educations? Not likely, right? So the better answer to this is not a cash out refi for their college educations. It's to have them work while they're in school. It's to have them go to community college, cheaper colleges, state schools, right? It's to save up for their education over time so that you can fund it out of their 529s or ESAs or UTMAs or UGMAs or whatever, right? Paying for a college education out of a cash out refi, I get it. Partially, I get it. If you just look at this objectively and go, hey, you need cash to do something, part of me gets it, right? But this should not be where we invest, right? What we would be saying here is that you invested in a mortgage, which is likely to have a much lower rate than what you could have made investing in the stock market over 18 years, right? And then you took the money out of the mortgage to pay for the college, right? When you could have been investing in the stock market, making higher returns over a long period of time, right? So don't bank on your cash out refi, right? Don't bank on something that you can't control the value of, right? And that's all I'm going to say about that. Don't bank on that for the college education of your children, right? So even though I understand mathematically some of the situations why homeowners do cash out refinances, I do not agree with them. I would not do them myself, okay? But again, I'm not going to chastise you for it. If you're doing it effectively, I'm not going to be mad at you, right? But I'm just going to ask you, what are your financial goals, right? And if your financial goal is to make the highest returns you can on your money, then, you're going to win that way, right? And the same can be said about investing in real estate and doing it with as much leverage as possible. If your goal is to make the highest returns, then you're going to want to lever up and make the highest returns you could possibly make, right? But if your goal is mitigating some risks and having long-term financial freedom, right? Not being tied down to any potential risk in your financial life, the inability to pay some debt at some point, right? Then getting your home paid off and keeping it that way will be the fastest point from A to B. Now, how much cash can you get from a cash out refinance? Well, for most people, the largest amount of money you can cash out is 80% of your home value. But remember, most cash out refi lenders require at least 20% of equity in your home. So if you don't have more than 20% of equity in your home, you wouldn't even be eligible for a cash out refi. And don't forget, you also have to pay for closing costs, which can cut into your cash out money in the first place, right? So what are the fees for a cash out refinance? Well, similar to buying a home with a mortgage, cash out refinancing comes with fees that you pay at closing. Those closing costs cover things like attorney's fees, lender's fees, the home appraisal. But keep in mind, if you try rolling these fees into your new mortgage, it'll probably increase your interest rate as well. So that's something to think about. Now, how is this different than something that we've talked about, not recently, but in the past, the home equity loan? Well, cash out refinancing, home equity loans, and home equity lines of credit are all different ways to borrow from your home's equity. Basically, take debt out in order to take money out of your equity. Now, remember, a cash out refi involves taking out a bigger loan to pay off your current mortgage, right? You're taking off a big loan, paying off your current mortgage, and then taking some cash out, right? You collect that difference in cash. Now, on the flip side, the home equity loan and HELOC plop a second loan on top of your current mortgage. The home equity loan allows you to borrow one lump sum of your equity, while a HELOC allows you to borrow multiple sums of equity at a time, like using a credit card, right? To choose between these, homeowners usually find out which option gives them a lower rate and lower closing costs, right? So they really basically do the same things, but the HELOC is more revolving. The home equity loan is going to be, this more one-time hit, and this second mortgage, this second loan. But this cash out refi will be your new loan, right? It'll be the new primary loan that you have. So what are the pros and cons of cash out refinancing? Okay, so this is to see if, cashing out your equity is worth it. So here are the pros and cons that I have for you. Pros is that you don't have to sell the house to cash out your equity, right? In many cases, if you want to get the equity out of your house, the basic way you're going to do it is to sell your house, right? And realize the market value of your home, and then you'll pay off whatever loan you had left and have equity, right? It is a fast way to access a ton of money, right? To do some very big things, right? There's no doubt that you could access large amounts of money by having substantial equity in your home and cashing out. Other pros is that interest rates might be lower than with personal loans, in that you can make a spread on the interest rates offered, which is, again, undeniable because the math is there. But again, what are we doing here? So that brings me to the cons. So what does this do? This turns your home equity into debt, right? It turns equity that you have into debt that you're going to have to again pay off, okay? It keeps you in debt for longer, right? When you might be close to paying off your house, right? You might be really close to paying off your home and then do this, and now you're kind of rewinding 15 years to this point where you're like, man, is this thing ever going to get paid off? Are we ever, it steps in the wrong direction. And then a bigger loan, last con here, bigger loan brings a bigger risk of losing your house if you can't make payments. Now, we all assume not we all, but many of us assume, oh, I'll always have a job. I'll always be able to work. I'll always be able to have this income. I'll always, always, always. Well, what happens when things don't remain static? What happens when a COVID-19 hits? What happens when a black swan event hits, right? That's the second time I've talked about black swan this week, right? But what happens if something like that happens and now you can't make payments on your home? And you could have had it already paid off, but instead you did a cash out refi. Well, now you could potentially lose your home, right? You could potentially be foreclosed upon because you didn't make the payments that you were supposed to make, which again means that you are taking more unnecessary risk in your financial life. Too much debt over too long a time is just asking for trouble, right? So that's why I don't suggest that this be the case for the vast majority of you all out there. So is it worth it? Cash out refinancing is not worth it for most people, okay? I'll never tell people to borrow money in this type of way under reasonable circumstances. Now, getting a mortgage is the only debt that I'm not mad about you getting, or I'm not upset at you for, right? Or that I don't think has to be paid off immediately, right? But trading in your mortgage for a bigger one is dumb, right? And especially if your reason for doing so is to pay for things that you could otherwise budget and save up for, right? It's taking the idea of delayed gratification. It's taking the idea of, living below your means, and it's just throwing it out the window and saying, well, I can do this now, right? This is the whole adults, they devise a plan and follow it, and children do what feels good, right? This is doing what feels good. If you're considering a cash out refinance because you're up to your eyeballs in debt and want to get on top of it, right? You could just, pay the debt off in a reasonable way. Now, what I would understand if you were in a place where you were going to have to, be bankrupt or whatever, and you had a lot of home equity and you could pay off some other debts or whatever, right? I get that. Or even if the interest rates on some of your larger debts are super high, I would still understand that. Again, the math makes sense. But if there's any possible way that we can budget and that we can effectively pay our debt off over time, right, you're going to be more efficient in doing that than doing a cash out refi. Because once you let the cat out of the box with the cash out refi, you'll realize that, hey, I have this ability to get all this money in my hand. And for some people, having too much money in their hands is an addicting thing and can get them in a position where they're doing this a lot of times and they're fooled into thinking that it's a good idea every time when it is likely not. Now, bottom line is that many debt products can fool you into thinking that you're making financial progress when you're really just moving laterally, right? You're just shifting debt from one place to another, right? If you want real wins in your financial goals, then budget for them, pay for them in cash, save up, do all of the right things in that way, and only use a cash out refinance as a last option for something. Again, I understand the math. I understand that financially you can make the best returns if you invest this money in whatever, right? But I won't be doing it. I don't suggest that you would be doing it. I don't think it's the fastest way to long-term financial freedom. But hopefully this episode has helped you to understand what a cash out refinance is, how it works, how it can be beneficial to some, and how it is very not so to others, right? But I think it's something we need to talk about when housing prices have increased as much as they have, and that this idea of refinancing and these cash out refis that are being talked about on TV and commercials, when they're in front of your face, you need to understand what they are instead of being sold a product that you don't fully understand and maybe getting into this trap that you don't need to get into. So hopefully this increases your understanding and your ability to stay away from going into further debt on your home unnecessarily. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan. And that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And if you need somebody to help you to create a financial plan that's specific to you and your family's needs, then I can help you do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions. And then you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. So tune in tomorrow as I continue talking about personal finance topics that I think could be useful for you in your long-term financial journey. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.